Hi, everyone. For those who just logged on, my name is Dominique, and I have the rest of the Greenleaf team here with us today. And today we will be discussing our recent government deal, 2300 Lake Park. Now, first and foremost, Greenleaf hosts weekly live streams and private connect events every Thursday afternoon with a new topic every week that highlights a portion of our business. Private events are more interactive, while live streams are open to the public. So folks, before we dive in here, we want to provide a quick overview of what to expect this afternoon. We will, as always, start off with some rules of engagement, dive into 2300 Lake Park and the financials and cash flows, and we will break out into our Q&A session at the very end. All right, to start with some rules of engagement. First, you do have the option to change your presentation view. Feel free to switch your attendee presentation mode to speaker spotlight, or you can click and drag to make the presentation of our panelists bigger or smaller. Like I mentioned, there will be a Q&A portion at the very end, but you do not need to wait to the very end to submit any questions you may have. You can click the Q&A button located at the bottom of your screen to submit your question, and our team will be sure to answer them. This is a friendly reminder that this live stream is recorded and will be shared with you via email by the end of the week this week. So without further ado, I will pass it over to our hosts, Dave Codray and Nathan Etheridge.
All right, thank you very much, Dominique. We are excited to be here today going over this new opportunity we have. This is right here in Atlanta. We have a bunch of pretty pictures up here on the front, kind of the evolution of Greenleaf as we've been looking at more of these nicer and nicer commercial assets. This is a deal that Nathan found, and you can see it looks pretty awesome on the outside. I mean, the view from the aerial view too, if you're going further back down, past it, this is, it's in Marietta. So I mean, you're basically looking right downtown the whole way from this building all the way downtown. And then if any of you know Atlanta, there's a giant elevator tower that's it's like just north of 285.
Right by the stadium.
Yeah, right by the stadium. You can see it for forever, basically. It's one of the tallest buildings out there. So that's right behind this building. So it gives you an idea of where it's located in Atlanta. So if we talk about like the property as a whole here, again, I mentioned it's fully government, but it's 87,000 square feet, very similar to our TVTC deal that we did in kind of size and feel and look and everything.
Definitely. Yeah, glad to be here today to walk through some of this. When we used to fundraise a deal, I would field 15, 30 phone calls sometimes at, half an hour a piece. So it's nice that we've, upgraded kind of our platform and we can talk to 40 people at once. Dominique, is that what you said we're on this call? So, Greenleaf definitely growing in its capabilities and technology. And this deal specifically, I always want to get brought in as the deal guy to talk about it. And like Dave mentioned, there's that giant tower being built a few miles from here. I think that just speaks to Atlanta and how, it's one of the top markets, if not the top market in the Southeast. And so that's where this deal is. So that's a great point about it. And then, we're getting it at a great basis, around $100 a square foot. Another thing I love about it is a stable deal, but it's an 8 cap with a little bit of room to improve it, being 90% occupied, filling up that vacant space. And like Dave mentioned, best of all, it's anchored by, probably the top tenant you can have in the country, the federal government, from a credit standpoint. And those tenants have a long lease, bringing the average in this building up to 6 years. So, really a good firm foundation.
Yeah, we think about that lease term. So essentially our hold period, we're projecting out 5 years. Our government tenants can be near that entire period. So we feel very good about that aspect. We dig into the location a little bit more here. We have a lot of green leafs all over the board here. These are deals we've done all over Atlanta. And then you can see our Greenleaf home office. That's where Nathan and I are sitting right now, our international headquarters. And then on the left-hand side, you can see the Brave Stadium and where this deal is located.
Yeah, Atlanta's our hometown. It's where we are. I could drive to this property and, depending on what time it is, be there in 20 to 30 minutes. So it's our hometown. We have all of our deals here, and it's the hub of the Southeast. 10th largest economy by GDP. It's got 6 million residents, 160,000 businesses, and state capital, and the world's busiest airport. So I mean, you could go on and on talking about how great Atlanta is and why everyone's trying to buy here and why we're buying here and continuing to buy here. And then, go fast forward, zoom in and look at Lake Park. It's located in Cobb County, which has gone through tremendous growth and investment. And a lot of that stems from, it's got a top public school system in the country. And, it's a heavily built out retail corridor. Like Dave was mentioning, the elevator is right next to the Battery, the home of the Atlanta Braves, which is just, I think it's $1 billion+ development. So
They're not doing too bad this year.
yeah, that's probably helping the development. It's going to be $2 billion now. The Braves are winning, but just phenomenal location, good market, good micro location.
If we look at deals that have sold in this area, we've been on both sides here. We're looking at this deal. We've also bought other deals that are very close by, and then there's other groups that have bought stuff outside of us, obviously. But if, looking at the map, the two that are on the top there, it's kind of right where it says East Cobb on the map. Those are two deals that we recently purchased, being Johnson Square and Crossing Center, which is the second Crossing Center complex we've purchased. But there's a lot of other transactions right around where this deal is.
Absolutely. So we're highlighting 6 here, 2 that Dave mentioned that we just recently closed on, and then getting a little bit closer to Lake Park, we highlighted 4 other deals. And you can see on the table, the basis point comparison, and it feels really good that we got this deal at $107 a square foot, compared to, another line item we have on the table is CoStar aggregated, every like property that was sold in the last 3 years, and that average per square foot was $140. So, it feels like we're getting a pretty good deal, high level, and then kind of on a more focused level, the only specific deal I'll point out here is you can see our neighbor, 2400 Lake Park, was sold for $84 a square foot. And I think it's important to compare those two, that building very close to the same type of property, sister property, but they have lower occupancy, it's more classic condition, and most importantly, they don't have an anchor tenant like the government.
Classic condition is a good way to describe
Classic condition.
things.
So there's a lot of info on here, and if you guys who are on the call want to dig into any of these specifically, type into the chat, and we can come back to this page later.
When we think about the value that we're looking for, I need to mention this deal is 90% occupied to start with. So there's a 70 to 90% that it's like, okay, it's not that much of a challenge to get that filled up. But if it's in a very low occupancy range where you see the 2400 Lake Park, like that definitely has a value hit because like, whoa, wait a minute, I got to go lease 60, 70,000 square feet. Like that doesn't happen overnight.
Those big tenants take time. You can wait years to find a 30,000 square foot tenant, or you can find a 2,000 square foot tenant in a couple months, but you have to find 20 of them.
Yeah, and this deal is like it's 90% occupied to start with. So we do have some vacancy, and there is some room for growth and stuff, which will help on the sale pricing. We see some value there, but it's not vacant.
It's a very good sweet spot for the Greenleaf model.
So if we look at lease comparables, like what else is happening in the market here in similar buildings?
Sure. On this page, it looks very similar to the sales comp page, and we do that on purpose because if we're comparing this deal to other deals on a sale basis, let's try to compare them on a leasing basis. So all of these comps are either the same building that we just compared to sale wise, or a similar one in the same office park or similar area, so that we're kind of doing an apples to apples. And looking at this top line, you see that on average the Lake Park leases are a little bit behind the other comp set properties, which is a good thing. We don't want to come in and maybe lose these tenants because they're overpaying. We can keep these here, and that average at 1712 is below what recent activity has been. They just signed a lease not too long ago at 1850. So that gives you a good kind of comparison set. And then looking at CoStar, grouping the whole market, they're at almost $22 and we're at 18. So it's good to be that bargain option sometime and not have to compete with everybody kind of that higher top end of the market level.
Yeah, so to recap that, we feel like we're getting a good price point on $1 per square foot, and we feel like our rental rates where that right now are not too high. We have room to grow and really helps us with a drive to even gain more occupancy. All right, so if we look at the investment overview as a whole, so we mentioned this $9.3 million is the contract price. We have about $1 million in capital improvements that we plan to do. And then our total deal cost will be around $11 million. That's where we're sitting at right now. So $11 million total capital stack. And then you want to talk a little bit about our returns on that and kind of where we're going, what we're looking at?
Sure. So some good information on this page, some pictures, but, only thing I want to point out, bottom left of the screen, you'll see the preferred returns. This is the amount on your investment that you're going to get paid from Greenleaf. And that cash comes from cash produced by the property. So then if you slide to the right of the slide, these are two snapshots in year one, what the cash flow is going to look like and some key metrics. And then in year 5 at the bottom of the page, what the cash flow is going to look like in key metrics. And so you'll notice in year 1, we're projecting 6.5% return, just below that pref rate. But with good news, we were a little bit conservative in our underwriting, and we've gotten some CapEx quotes back and got a credit from the seller that's going to creep that up closer to 7%. So it should be paying out, day one with this property.
Yeah, we're going to do, one of the things we're doing now too is kind of like a 6 months check-in. This capital improvement number of $1,081,000. There's a little bit of, we're trying the best we can to get that as accurate as possible and using engineering reports to really hone in on that. And then we also add a 10% contingency and a 10% kind of GC assumption that we're going to have to hire a contractor to do this work and they're going to make some profit on it. So we have that baked in there. So there's a good amount of buffer. And as we work through all that CapEx, that's when we really, hone in on the actuals and get that down as tight as we can.
Which is usually a better estimate than I create in the beginning based on limited construction knowledge, but just experience and then going and seeing the property.
Yeah. But it basically gets better as we go through the life of the deal with more and more accuracy. So we're going to go through our CapEx strategy a little bit here. We've got a couple of the key things that we're really doing when we go to an asset of this size. The main thing I want to point out here is our price per square foot that we're acquiring. We're in around 110, and we're going to spend about $12 a square foot on CapEx. And just from that 10% overhead, 10% GC, it's about $10 in hard cost and 20% buffer we have. So $10 a square foot, $2 a square foot in buffer. But yeah, a lot of this too is TI and leasing commissions.
Sure. Yeah, we started out at $1 million, which almost a quarter of that is money set aside to fill the building out from its 90% occupancy to fully occupied, and put money into the building to incentivize tenants. But that $1 million mark is dropping down with the seller credit, with tightening with some of our actual quotes for the CapEx. And I know $1 million seems like a lot, but I just want to point out the building is in good shape. They're taking care of it, but it is older than Dominique, and so it just there are some aging components that we just need to replace, and that's where a good chunk of that money outside of reserving for TI.
And that TI and lease commissions like that could sit there until we use it. So that money's kind of in our reserve bucket.
Right.
We're holding that until we use it. So it could be. Well, ideally, we're spending it right away because we signed a lease and we got to fix something and move them in right away. But it could be over time as we use that money, but we still have that bucket there to be able to use it. So I want to show you now what this 90% occupancy number looks like. So we have a really cool graphic here. This is kind of taking the building, imagine cut it in half and spin it sideways, and now you can see who's stuck in the middle of this thing.
Right. This is our Lego chart. So this is kind of a building block of the building and who's where and how long they're going to be there. So, I think the really key point to point out here is that if you see the big green block and then the other green block on the bottom floor and then the blue one, navy one on top, that's all government federally backed leases that, have long-term and are the best credit you can get in a tenant. So that chunk of the building, no matter if everyone else leaves, those 3 tenants could pay all of our expenses on the building.
And if you look at it just from those red, green, and blue Lego blocks right there, they're over 60% of the space that's in the building. So the other parts of the purple, orange, blue, yellow, those are all non-government, the other ones.
Right.
So we have a little bit, which is the blue. Again, this is 10% of the building that is vacant, and it's these baby blue Lego pieces, the baby blue ones that are vacant right there.
Yeah, and the last thing I'd point out on this chart is this pictograph is, fitting Greenleaf strategy of being kind of low rise, single or double story buildings. This property slopes from front to back. And so tenants on the 3rd and 4th floor enter from the front of the building, and tenants on the 1st and 2nd floor enter from the back. So it still kind of has that lower density, separate entrance feel that's, kind of crux of this, recent office strategy we have.
Yeah. We're going to talk a little bit about our, how are we judging and assessing these buildings compared to others. If some of you were on our commercial recap that we did for the end of the quarter, we went through 2 comparisons, and we compared our usage of suburban office compared to usage of high-rise downtown buildings. And we've definitely seen a trend of returning to the suburban low-rise versus urban high-rise. What we have here is a data source that we use called Placer AI, and they're able to track all of the incoming and outgoing foot traffic from a specific location. And you can see here, really in the middle of the chart is April of 2020 that it has there. So you can see the front end is beginning of 2019. We go through, I know it's going up and down quite a bit here, but in that low point being April of 2020. And then now back up, and we're seeing a lot more foot traffic and usage really in the past 4 or 5 months on this asset. So we want to look at a tenant and be able to say, like, hey, are they actually going there? Are they actually using the space? And it's like, yes, they're using the space, and they have a lease until 2028.
Right.
So both good combinations.
Yeah. So if I'm looking at this trend line, it dropped to almost 0, where no one was going to the building in April and May last year. And then fast forward to today, there's more traffic than pre-COVID. So that, kind of eases some fears of people not needing an office space, or for this building specifically, people not coming into work.
And there's a big building in Atlanta, one of the coolest buildings that's down there. Would love to buy it if it was a discount, but I don't think it's happening anytime soon. But their foot traffic, middle of COVID, basically went through the floor as well, just like you see here in April 2020. And they're about 50% back on that foot traffic. So even our other deals that we did, the Crossing Center, we're way back on that one. This deal is even better than it was pre-COVID on foot traffic. So it makes us very confident what we're getting into here. So, all right, the next one, we're going to go away from a simple chart. We're going to put as many numbers on one screen as we can fit. So if you do have questions, you can type them in here, and we're happy to go through more of these. But I'm gonna give this one over to Nathan here and dig through all these numbers.
Right. I'll stay very high level on this one. This is an accountants and a numbers person's dream slide, but for the average person, there's a lot to take in. And so the only kind of 2 or 3 points I want to point out is that, this is the operating statement, where all the cash is coming in and what we're spending cash on during the 5-year hold for this property. And so if you start at the top, that's top line revenue, what we're getting in rent. And if you slide from year 1 out to year 5, what you're seeing is it's slowly moving up. And that's not us pushing rent. That's not us, leasing vacant space. The majority of that is from pre-negotiated, predetermined increases, annual rental increases in the tenant's leases.
Yes, you're taking that information, it's already baked into the lease, and just applying it into this pro forma.
Right. And then if you slide down 1, you have this red line, which is, it's not a bad thing. We just make it red so it stands out a little bit. This is vacancy in the building. And another thing you'll notice here is that it goes down as you move further in the hold. And that's just us, over time, leasing any vacant space that's there.
And even no matter what a deal looks like, we're always assuming some vacancy. So the reality, this deal's 90% occupied, but we're assuming still 8% vacancy.
Right.
So to hit our pro forma income numbers looking out in year 5, we're only assuming we're renting 2 2%, which is about 1,700 square feet.
Right, that's a good point to make, is that, we're modeling 8% of the building's always gonna be vacant. So you slide to year 5, there's a number in that vacancy row, because that's just a conservative vacancy factor we're gonna apply. We do it to every deal, most deals, just about every deal. But, this one, we've got, a good 8% margin in there.
If you've seen any of our triple net lease deals,
Triple net deals.
those ones are a little different.
Right.
Andrew Ziffer saying, no. And then we go into our expenses. Since, this deal's been around a while, and since it's commercial and well managed, we have lots of transparency into what the expenses are behind it.
Sure.
So we know what to put in here.
And I wasn't gonna mention it, but if someone's out there thinking it and gonna type the question, if they've invested in the Crossing deal or the Johnson Square deal, you'll notice expenses on a per square foot basis are a little bit lower than this one. And kind of the only difference there is the elevator. This one has an elevator to get up and down the building, which are a little bit more costly to operate.
More costly than stairs.
More costly than stairs.
All right, so we take this information now and we push this into kind of our cash flow and return projections. And this sheet is really a summary of all of our financials and what our ultimate returns are going to look like.
Definitely, this is the boiled down kind of final product extension of the last page. What happens after the cash leaves the property and comes to Greenleaf, and then ultimately back to the investor. And so, the really cool thing on this one that I want to point out is towards the middle of the page, there's the personal experience of an investor. If they were to put in $100,000, you slide right, that's going to be your cash flow during the hold. And then in year 5, you see it jump a lot, and that's with us selling the property and returning cash to the investor.
And we're assuming we sell it at a 7 cap.
That's right. Down at the bottom, we have a sensitivity analysis that at an exit, we're planning on selling at a 7 cap. A lot of that's driven by the GSA tendency, which tend to trade a little lower on a cap rate basis than a general office deal. So we have, returns that we're projecting at that rate. And then if the market gets a little hotter, move to the left, that's what returns will look like. If something were to go wrong and the market values the property less, then you go to the right. And that's kind of the projected return that we're looking at.
Yeah, so even exiting at an 8 cap in year 5, we're still hitting the 10% IRR.
Right, which is 10% a year. So, you're invested in the stock market, they say 8 to 12% a year since the beginning of time. This one, we're projecting, kind of on the lower end of scenarios, still being 10%.
And a lot of that is this government tenant that's the bulk of the space and guaranteeing us that return throughout our projected hold period.
Right.
Okay, well, that's the bulk of it. We're going to go into the Q&A session now, and Natalie King's going to join us and help answer questions that we have on the deal and some of your input that has come in here over our presentation.
Thank you, Dave, and thank you to everyone who submitted questions. We had a ton come through, so you guys be ready. We also want to remind you that you can continue to use the Q&A feature at the bottom of your screen to submit questions as we work through those that have come through. Let's go ahead and get started here. Okay, so the first question we have, Nathan, this one's for you. Why is the seller selling the property?
Yeah, that's a great question. And we get it a lot. With this deal specifically, so if you remember the sister property that we looked at that recently sold for less than this deal, that's a similar situation to the seller. They bought this deal with low occupancy, being in classic condition, needing some love, needing some injection of capital. And so they bought it, I think it's about 5 years ago now, at a steep discount, fixed the building up, brought in those GSA leases, and then now this is about as valuable as the building is going to be for them, and they've had it for a while. Time to recycle capital. So that's why it's listed and they're selling it, and it's a good fit for someone like us to kind of milk the last bit out of it, but then also reap the benefits of the hard work they did.
Next question, how long are you estimating it will take to lease the vacant space? And do you have any concerns on leasing this space?
So, we're overall projecting to hit our pro forma that we only have to lease, like I mentioned, about 1,700, maybe 2,000 square feet. And tenants in that range, especially in the suburban office market, we've just in this year alone, we've signed about 40 leases kind of in that size range across all of our commercial assets. And a mix of that has been expansion of an existing tenant or a new tenant coming in. So that kind of sweet spot of like a 1,500, 2,000 square foot lease, we're very confident in executing those. From a full lease up standpoint though, some of the spots are a little goofy. It's easiest if we get someone to expand into it and take over their a part of it that's missing. But we envision within the first year we'll be at our occupancy goals.
Sure, it's a good point to point out that we had earlier that we had that 8% vacancy factor. So all these numbers aren't contingent on us coming in and leasing a bunch of square footage. It's about 2,000 square feet, like Dave mentioned. And I met with the leasing team, and they're doing a great job. They're a real scrappy, boots on the ground. I think there's 3 people in the group that's doing the leasing, and they know everybody. They hustle. So this is a big project for them. And they're not the big companies who have millions of square feet to lease. This is one of 3 projects they're working on. They're doing a great job. And I imagine we'll maintain them at closing and maybe even expand some of the work they're doing because they're doing a great job.
Okay. How long have the GSE tenants been in occupancy?
So for the most part, they're signing 10-year leases when they come into a spot. That's fairly standard with where they're at. So if we look at current leases that go through 2026, 2029, we have one that goes through 2030.
Yeah, all 3 were signed within the last 2 or 3 years. And then the great part about the GSA leases, a lot of times there's a lot of synergy between one agency and another. So they signed the anchor tenant, the Department of Defense lease, and then the other smaller tenant, GSA tenant, followed them because they got into this building.
The next question is the IRS leased at $10.68 per square foot. Can you provide some color on why it's so low?
Yeah, this is a complicated, probably the most difficult to explain piece of the leases and the tenants. Most tenants outside the GSA, their leases are just full service gross. So they're paying a number per square foot and that's it. We do everything else. We handle all the expenses. We do everything. The GSA leases are a little bit different, and they were negotiated with a base rate and then a reimbursement for expenses portion. And then also when they moved in, the landlord fixed up their space and put in TI dollars that was amortized over the lease term. And so all 3 tenants are paying back the money the landlord put into the building when they signed their lease. So that $10 rate around there for the IRS, that's only a portion of their rent. If you added up all those 3 components, all 3 of those tenants are around $17 to $18 a square foot, GSA tenants. So I think it's just a little bit different way. It kind of shows the variability in leases and how you can structure them, this way or that way. Makes it difficult at times to compare one versus another. Yeah.
Can you discuss the benefits of a government tenant and what is the penalty for a tenant breaking their lease?
2 components to that one. The government tenant as a whole, the government knows what they're doing. So I know sometimes political opinions can shift on that kind of stuff, but like as a tenant, the government is very consistent in following all of the rules that are written into the lease. So there's not like, oh, I don't feel like I'm gonna do this or that or something like that. Like it's very black and white for them of the parts that they take care of and the parts we take care of. When they pay the rent, how they pay the rent, all of that stuff is very operationally smooth. So that helps a ton when executing with a government lease.
They also have very deep pockets. So if you compare, the IRS versus, another tenant that this is their only location and rent is 30% of their revenue, this IRS lease is not 30%
Of the IRS budget?
of the United States government's budget. So, it's just, they need office space, they need leases, and this is a very small check for them to write. So, and then pair that with, the United States having AAA, and they're probably even better than AAA. They've never defaulted. So tenants default, smaller tenants, with regularity on leases, but the government never has. And that that stability, that security, that's what really drives, you know, the value with these GSA leases.
And if there is a default, every lease is different. And, you know, our GSA leases are backed by the government for the full value of those leases. So if they're gonna pay $1 million over 10 years, like they back that. When we get into other types of tenants, they're signing a mixture of either personal recourse or business recourse against the life of that lease. And then even in smaller tenants, though, we do have buyout clauses. That's like, look, you can pay a set percentage of a lease, total lease value or something, and exit from that lease agreement. So none of them are the same by any means. They're all different, ranging from that full government backing all the way down to, you know, a small tenant might have just a personal guarantee on the value of that lease.
Right, just about every lease has a termination fee or get out early fee. And there's actually one tenant in there, can't remember which, it's the middle purple one. I don't remember how, Avisis. So their lease runs through the end of next year, but they want to move. And the seller now is negotiating with them. They've got another tenant to fill their space, and they're negotiating, letting them off their lease early because they've already got a tenant back to move. And what they're getting and what we'll benefit from is whatever that tenant owes for the rest of their lease, they're gonna give half of it to us to pay for the build out for the next tenant. So when we close on this deal or shortly after, that short-term tenant will be gone and there'll be a new one in there, fresh lease, fresh space. So that's kind of a, you know, real life example of termination fees.
This deal is very similar to TVTC, which was a partial government building, 2-story brick they bought up in Chattanooga. And then non-government tenants there, we had some move outs post-COVID, not necessarily associated with COVID, but like we had tenants that moved out, and then we backfilled that space with other tenants that were in the building taking more space. So it's similar mix to that strategy.
The next set of questions we have are, see how good you are at your building stats. So what is the age of the building?
It's older than Dominique.
That was built in 1983.
1983 or 85. That's the two days that came to mind.
Okay.
So
And what is the condition of the roof?
1985.
1985.
The roof's in good shape. So we had the engineer inspect it, and then we had our local roofing company inspect it. I think originally we were planning to possibly replace it, and then they recommended it still has some life in it. So just some repairs would get some more longevity out of it.
When a repair comes in and it's over 5 years, we mentioned we use criterion to do our engineering report. And if they come back and say, hey, look, this roof needs to be replaced in year 8. It's like, well, we're projecting everything on a 5-year hold, and we are reserving CapEx expense that if we did hold it to year 8 would get there. But right now we assume from our engineering inspections that it's going to last beyond our projected hold, and we'd be looking at something in year, you know, past that year 7, 8 or so.
Right. And it's not an original roof. So it was built in 85 and they've replaced it at some point on the line. I don't remember the exact date. So it's not original.
Great lead into our next question. Did the engineering report uncover any concerns?
Well, the $1 million we're spending isn't for kicks and giggles. So yes, there's definite concerns on things that we are going to fix, but it's not stuff that we necessarily have a concern about. It's more stuff that we're like, you know, we identify these issues and we know we can fix them and we know what we're going after. The biggest part of those things, I mean, we have a big chunk that's reserved for the leasing commissions and TI, but also there's a lot of stair work and metal work that we're doing on the exterior of the building. And then, you know, a 1985 asset that's got metal beams on the outside that are exposed, they've got to be maintained. So we have to make some repairs on that stuff. And we also have a lot of parking lot and concrete work that has to be leveled out. A lot of the sidewalks, and this is one thing the government is very good about, like if their leases require stuff and there's a sidewalk that's off by an inch, they're going to find it. So that stuff, you know, you have roots that push up a sidewalk. We'll go out and we level all that concrete work out. So that's something that we're going to be doing as well. So those definitely concerns and things we need to address, but they're not things that are outside of our comfort zone.
Yeah, I would break it down. The report came back pretty well with what we anticipated. You know, we knew there was going to be this fix or this fix, and there was only one item that was a surprise to us, and that item, we took that to the seller, told them we weren't planning on fixing this. We didn't know this was gonna be an issue. And they agreed, and so we're working out that seller credit we mentioned earlier, so.
For parking spaces available for vacant space, what would be the requirements for new leases?
So a tenant of that size probably isn't going to get any kind of preferential parking. I'm not sure that's totally where you're going with the question, but you know, our larger tenants, some of the upfront parking spots, you sign a tenant that's got 30, 40, 50% of the building, they're saying, hey, these spots are ours. If you sign a 2,000 square foot lease, you're kind of like,
They're in the
hey,
back.
there's lots of parking all over here. You can feel free to walk wherever you want. So they're not getting normally like a preferential parking arrangement, but the parking ratios that we have are fine to add additional occupancy that.
Right. Well, for office, you know, we look for 3 to 5 spots per 1,000 square feet, kind of depending on what the use of the building is. And this one, I think it's just over 4. I think it's just over 4, maybe close to 4.5. And if you've been to the property or you look at the satellite image, it's a lot of parking space. It's a big area with plenty of parking. And that's never kind of anything voiced by any tenants as being an issue.
Great. Dave, you'll be excited. We have some tax and depreciation questions for you. The first being, will investors receive any tax write-offs generated at the time of purchase from immediate depreciation of equipment, furniture, et cetera?
That is a good question, and there will be. One of the changes made during the Trump administration was that everything that's under a 15-year depreciable item got moved up to 1 year. So when we look at these buildings and we build our depreciation schedule, we have a mix of permanent building depreciation all the way down to like an HVAC is only going to have a 5-year useful life, which was longer, but it's not. So all that kind of stuff will be depreciated in year 1. So there will be year 1 losses from that. And additionally, all of our closing costs that go into buying a deal, when we buy a deal later in the year, we're not really going to have a lot of positive revenue out of the gates. So we have all of our closing costs along with all the depreciation that gets bundled into the first fiscal year that we have.
So that's specific to this deal. And then just for every deal, you know, we've got pretty much an accountant, tax guy on retainer in every deal. When we buy it, you know, we put it in front of him and he evaluates it. So just on a high level.
Yeah, we do that for all. We don't treat anything differently.
And would you consider doing a cost segregation study to increase depreciation in year 1?
Probably not, because you kind of have this like items that are under 15 years or items that are over 15 years. The over 15 years are not going, a cost segregation isn't going to convert the structure of the building to a 1-year asset. Like that's going to stay as a long-term asset. Cost segregation is really used to identify what are your shorter term depreciable items. And the previous administration changes to the tax code made that relatively simple, that everything 15-year and below is 1 year.
How much of a discount do you expect the modified gross lease to have versus a full service lease?
It's a tough question. So the range of leases, you've got full service on one end, you've got net on the other, and then modified is just somewhere in the middle. It's not really a number that you can peg. And so full service, think of it as they're paying for rent and they're paying for expenses in one number. And then we just take care of everything. And if expenses go up, then we're hurt by it. If expenses go down, we benefit from it. And then on the net side is they're paying a base rent and then they are physically paying for all of the expenses of the building. So they take on all the risk of any expense variability.
Yeah, they'll pay their own utility bill.
Right?
They'll pay all
It'll be
their
in
own
their
stuff.
name. We'll get the property tax bill, we'll send it to them, they pay it.
And
And then modified gross, you know, it's such a hard thing to pin down because, you know, pretty commonly it could just mean it's full service, but they're paying for their electric bill. Or it could be they're paying for literally everything but property taxes. So it's really hard number to pin down.
That's a great lead into our next question. Which expenses are paid by the tenants as opposed to being included in the base lease?
that is a good leading question. After that, that's a big mix. To take it from Nathan's point there, that's kind of a negotiating component when new leases are signed. And depending on kind of how that's done, if it's purely net, then it's easy because we're not paying any of, they're paying all of them. But we have a mixture across all of the tenants, and every single one of the leases is different on that modified standpoint. So
Specific to this deal, every tenant other than the government, the GSA tenants, are just full service, which is common when you see for smaller tenants, more suburban tenants, they don't want to have to do the extra work. They sometimes will pay a little bit more so that we'll do the work. We'll pay the phone bill, we'll pay the electric bill. And then the GSA tenants, another common thing you see is they are doing a fixed reimbursement. So they're not looking at the expenses of the building and paying a portion of it or paying for this or paying for that. They're just saying, we'll pay you this amount of money, which don't quote me on the numbers. I think it's $6 a square foot for two of them. And I think the other one's a little bit lower, right? $4 a square foot. So they're saying that this is our base rent. We know it costs money to operate the building, and this is a low rent level. So we'll give you money to help pay for those expenses. And then a nice thing about this deal is those expenses are not flat. They're tied to CPI. So they grow based on inflation year over year, which helps lower the risk for us managing if expenses increase year over year.
Our next question, does Greenleaf review refinancing and holding properties longer than 5 years in the projections? If so, could you explain what is reviewed to make the decision to refinance or sell?
We certainly do. We would, we love holding assets longer term and keeping consistent cash flow if we have it. We started the whole 5-year projection about 2 years ago, and looking at things from saying, hey, at the 5-year mark, we really need to assess whether we can take this equity and better deploy it, or are we getting good returns here and we see rental growth and occupancy, and we like where the project's going. We needed to pick a point of time to model it, so that's why I picked that 5 years. But depending on kind of what debt rates look like 5 years from now, what cap rates look like 5 years from now, we're going to assess that and determine, okay, is it the best investment to take the equity that we have in place and hold it and realize those returns, or should we go redeploy that equity and find better returns elsewhere?
Why do you forecast a 7 cap exit when you are buying a stabilized 8 cap?
You want that one? You want me to do it?
Go.
We both took the breath at the same time.
No, so yeah.
Go ahead, you do yours. I'm interested to hear what you
He's gonna-
say, and then I'll add what I was thinking.
He's going to jump in. So we're looking at when we're buying an asset, we're always buying something that has some not only physical but operational value add left on. And in this case, we're spending $1 million in capex. If we were spending $0 in capex, this deal would trade for a lower cap rate. If this deal was more occupied, it would also trade for a lower cap rate. We plan to do those aspects and then realize that cap rate compression. That is kind of our going in strategy on all assets we buy. It's like there's going to be physical improvements and there's going to be operational improvements. If we look at an 8 cap exit, that basically means we didn't do those things. So if we don't do those things, we would envision that we could sell it for the same price that we bought it for.
Nathan?
Yeah, it was well said. There's little that I would add to that. The only thing that I thought was interesting about this deal is they didn't really market it as a government deal. It was just an office deal, and office deals trade for about an 8 cap. So, we got a little bit of juice on the cap rate from there, but, they didn't list it with a government specialty broker. A couple of we talk to those guys all the time because we're buying these kind of deals, and they knew about this deal, didn't know it was being sold. So, I don't think that they marketed it in the best way as a government deal, which drives typically a lower cap rate than just general office.
Yeah, if we could fill it up with more government tenants too, it would.
If the whole building was government, 7 cap would be conservative. It would definitely, at this point in time.
Yeah, so even when we're going through our renewals and our leases and stuff, like that's very much top of mind. That is like any of the space that we can get another GSA or federal tenant into, it only helps our prospects of value down the road.
What are the terms of the loan, and will we be able to lock in today's low rates over a long term, like 10 years?
So the rate locks on loans are, it's a little tricky. Like we're in the middle of some refinances right now that, it's about a 2-month process to do. So, and then once we kind of get to the end, we don't really have a lot of, we're kind of stuck with whatever the prevailing rate is at the time. It's all based on the 10-year treasury. So that's where we stand with this as well. As we get closer to the closing date, we don't actually lock our rates until the very end.
But once we close, that rate's locked for the whole term. And this one's a 5-year term, I believe, and it's with, a major lender. It's Wells Fargo, giant lender, maybe one of the biggest lenders in the US. And it's kind of strange for them to go after this deal and be, competitive and us to choose them for an on-balance sheet debt, but they got really aggressive with this asset. And I think, it's because of the GSA, it's because of the location.
How long after close do you anticipate making the first distribution payment?
So we balance this distribution question with the amount of CapEx that we have. Essentially, we're going in looking at spending $1 million in CapEx, and we want to keep that money available. We want to make sure we don't over disperse and have a hiccup associated with that return. So we're looking at this from the standpoint of saying, like, how quickly can we get that CapEx and stuff done, and then how quickly can we get to making distributions. We envision partial distributions in year 1, as long as we're on track with CapEx.
And then just from a logistics and timing standpoint, we close day 1. After that, we start accruing prefs for investors. And then at the end of every quarter, we evaluate the cash coming in, the amount of cash in reserve, projects we're working on, and then decide what to distribute.
Yeah.
Distribute
And
out.
we're scheduled for September 30th closing. Is that our?
Right around there.
I think it's right at the end. So we're like right at the end of the, end of the 3rd quarter that we're aiming to close this thing. So then we'll have kind of the first quarter is that stability and make sure everything gets in there, make sure we're right on all of our CapEx stuff, and then pick up into the distributions.
Our last question for you, one that all of us locals want to know, since this is so close to the Brave Stadium, can we get free parking for the games?
It'd be a bit of a walk, maybe.
Yeah, it is close, and you can see it if you had jumped up 100 feet, but
We won't tell you.
yeah,
If you park
yeah,
there.
you won't get towed by us.
We'll put a word in management not to tow any investors who park it like park.
Yeah.
Well, wonderful. Those are all the questions we have. Again, we want to thank everyone for participating. And of course, we want to thank Nathan and Dave for sharing the 2300 Lake Park deal with us. As we wrap this up, we'll pitch this over to Dominique to review our deal timeline with important dates, as well as our upcoming live stream schedule.
Yes, absolutely. Thanks again, everyone. So we are preparing for a latest closing date of October 11th, and we are going to send out your subscription agreements September 7th for those investors who have already made their commitments. We ask for your subscriptions as well as funds due to be initiated by September 27th. On the right here, we have our Greenleaf Connect schedule. We did a deal update previously for our Summit Medical investors. We recently discussed the 2300 Lake Park today, and we want to invite all of you to our Greenleaf investment strategy live stream that will take place September 2nd. So if you are interested at all about the office strategy or more of our commercial strategy or residential strategy, please feel free to register for that upcoming live stream. Everybody is invited, as well as we want to provide a friendly reminder to our Park Hill investors. We will be sending out live stream event details pretty soon, but that date is to be determined as we settle out a couple of last minute details there. So thank you everybody for joining today. This concludes our regularly scheduled program. Don't forget to check out our Greenleaf Connect YouTube channel for all of our recorded live streams, with this recording being made available by the end of the week. We certainly appreciate you joining us today, and we look forward to having you on our upcoming live streams. Thanks again and enjoy your day. We are going to stay online here for a couple moments or so to answer any last minute questions. Other than that, have a great day.
All right, thank you very much, everyone. Yeah, it says October 11th.
End of the month. I knew it was
Yeah.
close. That's with an extension
Roughly
too.
close. It's like at the end of the 3rd quarter. Wrap things up in the 4th quarter. Go in Q1 of 2022.
We might have some
No
more
no one
for
sneaks in
you.
any last minute questions
Well,
for
we
us?
have some that are not this deal related.
Okay,
Do you want to take that one?
sure. If there's
What's
still
the
one.
timing of the Rosecroft refinance?
Oh, man. We still have not gotten through our final underwriting package with Fannie there, so we don't have a time frame that we can get a commitment letter, but it's within 30 days. Those, the Fannie, Freddie, the smaller loans like that, they basically give us a commitment letter, and once they give us that commitment letter, we close within a week. But getting to that commitment letter is that kind of 45-day process, and we're in the middle of that right now. So optimistically, though, it should be in September.
And when will you be distributing info on the Alabama office deal?
You have an answer now, or?
Yeah, it'll be a little while. That one
16 days.
is gonna take a while. We've got to talk to the tenant about expanding, and then we've got to do some dividing of the parcel. The owner owns this building in the front, the building in front of it. But that one's gonna be slow. We're probably a couple months out.
That's our similar strategy on the Alabama deals, when we're buying deals that have some vacancy, and we're trying to position ourselves that we can work with the tenant to assume vacant space in the middle of kind of closing and time things. So we really hit the ground running. So we're in the middle of it.
Right, that deal, we buy it as is an okay deal. If we get them to expand while we're under contract, it's a home run day one.
That impacts everything too, from the amount of equity we've got to raise, we have to raise for vacant space, and what does our debt look like?
So those deals are tricky, which is why we get rewarded.
That's why we
for
like
it
them.
if they
Yeah, that's
pay
why
out,
we,
you know.
that's why I like them. Those are like little curveballs at the end. Anyone else left has a curveball, yeah, we'll take it.
So I have 8 people on with us.
All right, well, if there's no other question, we appreciate y'all tuning in, and hopefully this was helpful on Lake Park. We're very excited about it. We like the aspect of the federal government being there and really capping our downside risk associated with their lease.
Did we mention how much room we have left?
We only have about $600,000 left on this fundraise. So our total equity was around $3.5 million going into this. That we're looking at. So we have 600 left right now. All righty.
Signing off.
No other
Zoom room.
questions from we need a better name for this beautiful space that we're in.
I like Studio One, but
Studio One is taken.
Thanks, everyone. Bye-bye.
Thank you.